Welcome to Bloomberg Technology. I'm Emily Chang in San Francisco. Now it is not just President Trump, but his opponent taking on Facebook. Vice President Joe Biden sending an open letter to Facebook calling on the social network to fix itself in the midst of continuing controversy over how to handle political speech on the platform. We will have more on that in a moment, but first, market turmoil. Stocks plunging the most in 3 months. U.S. jobless claims continuing a gradual decline and increasing concerns about a second wave of COVID-19, with cases surging past 2 million in the United States. Texas numbers have been hitting new highs, and Houston is now reimposing its stay-at-home order. We are going to continue to follow that, but first I want to bring in Kaylee Lyons, who's been following the market moves with us. Kaylee, the worst day for equities since the bottom in March. Talk to us about what is driving stocks down.
Yeah, it was a really ugly day for sure. I mean, the losses on the three major averages ranging between 5 to 7% in the case of the Dow. As far as what is driving it, really, it probably was a multitude of factors. You did have that more grim economic outlook coming from the Federal Reserve yesterday. Layer on top of that, the concerns about a possible second wave of the coronavirus and the very simple fact that we had just run very far, very fast. Valuations are at their highest in about 2 decades, so there may have been a little profit taking involved in this equation as well. But what was noteworthy to me is the fact that, you had small caps really underperforming. They've kind of been a proxy for that recovery trade, but they were down 7.6% today. You also saw yields tumbling across the curve, specifically on the long end, with the 10-year yield down about 6 basis points. And the breadth of this sell-off, also something I was paying a lot of attention to. On the day, out of the 505 stocks in the S&P 500, only one closed up. That was Kroger, one of the classic kind of coronavirus safety plays. Those fared a bit better than everything else today. But again, 504, of the stocks did end the day in the red, Emily.
So where did we see the hardest hit areas?
What was so interesting is it was the areas that had been outperforming in recent weeks, those kind of cheaper areas of the market that retail investors in particular had just been flooding to in recent days. Saw that trade totally reverse. The rotation did a 180 yet again. The growth sensitive areas of the market were the biggest laggards on the day. Think the energy sector, which was down 9.5%. Energy, financials, materials, industrials, all leading the losses lower. And of course, some of those travel names too that retail investors have been really involved in. Norwegian Cruise Lines, for example, United Airlines were each down about 16% in today's session. You're just seeing a lot of those trades from recent days unwinding today.
Meantime, tech had been outperforming, but appears not so today. Facebook shares down more than 5%. We're going to talk a little bit more about pressure now coming from Vice President Joe Biden. Walk us through the tech moves in particular.
Yeah, it's so interesting because the NASDAQ actually was able to close up on the previous 2 days of sell-offs we've seen. That was not the case today. Even big tech couldn't withstand the risk-off sentiment. Now, some of that is just the broader risk-off sentiment, but those idiosyncratic stories that you mentioned, you have kind of regulatory risk coming back into the picture. That's true with Amazon, which was down by some 3.4%. That's all an EU story, facing a formal antitrust complaint from over there. But then Facebook, as you mentioned, down by 5%. It's really reminding us, Emily, that big tech is kind of a bipartisan issue. It's not just President Trump that is targeting these social media companies, but coming from the vice presidential Vice President Joe Biden, the Democratic candidate for president as well. And finally, I also want to point out Tesla. This isn't so much a big social media story as it is. This was the story in which you'd seen a lot of the market euphoria playing out in a single stock. But like we saw today, that euphoria kind of unwinding today, and Tesla is back below $1,000 a share, Emily.
All right, Kaylee, thanks so much for that update. Appreciate it. I want to move on now to that Facebook story. Vice President Joe Biden singling out Facebook, calling on the public to sign an open letter to CEO Mark Zuckerberg, saying the social network has failed to stop disinformation and that the U.S. election, this upcoming presidential election, is at risk. I want to bring in David Kirkpatrick, our Bloomberg contributing editor and, of course, Facebook expert. David, obviously we've been covering now for almost 2 weeks this particular post by President Trump in which he suggested that looters be shot. Mark Zuckerberg took the stance that that post should remain untouched. We've seen Facebook employees, Facebook former employees not happy with this. And now the vice president himself. What's your take?
Well, I think there's no question that Facebook has failed to stop disinformation from spreading. Facebook does a lot of other things, many of them good, but they have really failed in that department, not just in the United States. What is so interesting, though, is to see Vice President Biden, Democratic presidential candidate, coming out and basically pointing his guns at Facebook, blaming it for, to some degree, I think, what we've seen of the empowerment of Donald Trump. He doesn't say that exactly, but clearly that's what the campaign sees. And Facebook is really vulnerable to this because it really, even though, as you pointed out earlier, President Trump has been critical of social media. In reality, Facebook has done literally nothing that he could complain about. They have tended to really favor his messaging over any other messaging and really bent over backwards to enable him to do whatever he wants. And the most notable thing about what Facebook's doing right now is that it has an explicit policy that in advertising, politicians are allowed to lie. That is an extremely controversial policy for which there is almost no support except on the right.
Right. And in this open letter, Biden calling on Facebook to promote real news, not Facebook, fake news, remove viral misinformation. He had a few tweets rolling this out saying, folks, we saw in 2016 what can happen when social media platforms are left unchecked and allow disinformation to run rampant. It puts the very integrity of our elections at risk. We simply cannot let it happen again in 2020. Facebook, meantime, responding, saying, just as they have done with broadcast networks where the U.S. government prohibits rejecting politicians' campaign ads, the people's elected representatives should set the rules, and we will follow them. There is an election coming in November, and we will protect political speech even when we strongly disagree with it. What do you make of Facebook's argument here?
I think it's disingenuous because, of course we need better rules, and they're right about that. We need legislation in the United States and elsewhere that very clearly establishes what should and should not be allowed on these platforms. However, Facebook already makes tremendous number of subjective judgments about what kind of speech should be permitted, and they have explicitly excluded paid political speech from those rules. And that's a choice they made. It has nothing to do with the law. That's a statement. It's one of those statements you make just because it sounds good, because you don't really want to engage with the critique that's coming publicly, in this case from Vice President Biden. So I don't think it carries a lot of weight, but it's just another example of the kind of mealy-mouthed Facebook statements that more or less seek to justify doing nothing in the face of particularly President Trump's incendiary language, which in the case of Twitter they decided had to be labeled or hidden behind a warning.
Meantime, you have Chris Cox, who was one of Mark Zuckerberg's most trusted lieutenants and left last year, now coming back to the company as chief product officer. He had left over a disagreement about the direction that Facebook was taking, Mark Zuckerberg taking the company more towards more private communication, private messaging. Now, Chris Cox coming back in the middle of this controversy. Why do you think that is?
Well, from the standpoint of Facebook, it's a much more important development, in my opinion. Chris Cox is a critical employee who was with Facebook from the earliest days, and for most of Facebook's history has been Zuckerberg's closest sort of partner in almost everything, and somebody who played a tremendous role in defining the ethos of Facebook. So he left in early 2019 in disagreement over the policies about encrypting messaging, which Facebook is heading towards doing. His return to me is indicative of Facebook, Zuckerberg personally realizing he needs help navigating these recent crises, particularly things like employee revolts that he's been experiencing around this issue of political speech, which is unprecedented for Facebook, the kind of criticism he's been getting internally and from ex-employees just in the last 2 weeks. Chris Cox has enormous good judgment, a very big picture view, and is deeply well respected. on issues that Zuckerberg, frankly, is not as well respected on. They're both well respected as technologists, but Cox is really somebody who's respected for his humanity. And I think, we would have to say, for all of Zuckerberg's virtues, that's not the way most people think about him. So at this moment in Facebook's very tumultuous history, when they're being challenged from right and left for their behavior and have to make ethical and moral judgments, he is a perfect person to come in there and help. So I really am glad to see that.
All right. Well, we'll continue to follow this, as I know you will. David Kirkpatrick, our Bloomberg contributing editor and author of The Facebook Effect. Always good to have you here, David, on the show. Coming up, we're going to be talking about Tesla nearing a historic milestone as the world's most valuable car maker. We'll talk to Colin Rush of Oppenheimer next. This is Bloomberg. Tesla is nearing a historic milestone, getting closer to displacing Toyota as the world's most valuable car maker. Shares of Tesla rising 23% since the start of June. This giving the electric car maker a market cap of more than $190 billion. Toyota's, meantime, $212 billion. To discuss, we are joined now by Colin Rush of Oppenheimer, who currently has an outperform rating on the stock. Colin, is this warranted?
Really what's at stake right now is the technology future for passenger vehicles. And at this point, Tesla has some key advantages that they've been able to demonstrate in the market. The first is really around the battery technology. That we do think that they have meaningfully differentiated battery technology in advance of their competitors. And beyond that, their understanding of that battery technology through the powertrain is incredibly important in terms of efficiency of the system. And we do think that's a sustainable lead, which is why we're constructive on shares. Now, the second piece of this is really around autonomous driving and advantages on that front. Tesla's taken a unique route in terms of their sensor set, but the thing that they have going for them is hundreds of thousands of vehicles on the road in test mode where they're collecting data. And at this point, the technology is at a place where we're looking at corner cases, or really the last 1% of cases where you're collecting data on how to navigate those scenarios. And Tesla has an order of magnitude more vehicles on the road collecting data at this point. And that's an important advantage that we think is getting priced into the stock at this level.
Meantime, Elon Musk himself has said that he thinks Tesla's stock price is too high. Tesla's stock price is too high, in my opinion. He later followed up to that tweet saying that he, as always, believes in Tesla's long-term future. And then, now that this all is happening, he tweeted, LOL, laugh out loud, about the time this story broke about Tesla nearing this historic milestone, then tweeted stonks, which is a finance term related to an elevated stock price. Is he pushing the boundaries of what he should be doing here?
I think he certainly is, talking about stock price in a way that the SEC may frown upon. But I think at this point, the bigger question is less about his behavior and more about what's going on in the broader market with the prospect of persistently low interest rates, what's happening with fund flow, electronic trading, and really investors pressing, what they perceive as technology winners in the market. I think we're at a place where, some of the inflationary pressures, from low interest rates are beginning to be seen into equities, and some of the fund flow as people are looking for returns in a very fluid and dynamic market. We're seeing even more fund flow into the equity market. And so, although I'm not a strategist, we are seeing those dynamics play out within our coverage universe. And so, I think a lot of folks are really struggling around valuation questions right now, and concerns on a number of major question marks, given the broader economic disruption that we've seen over the last quarter plus with the coronavirus.
Right. I mean, Elon Musk is the CEO of Tesla and knows more about the company than literally anyone. Shouldn't it concern investors that even he thinks the company is overvalued?
Certainly, he made one tweet, and the second tweet, we aren't really focusing on his commentary around that. Certainly, the concern for us is if he's in violation of his SEC agreement around commenting on the stock. I think the investor base is really looking at what's going on in terms of on-the-ground activity, in terms of production levels and gross margin activity, and really we're looking at the China factory as a really important benchmark as they get it to full ramp on that to look at what Tesla's manufacturing future will look like and what the margin profile of its products will look like over time. And I think that's the thing that we're most concerned with. At this point, in the near term or the long term, we're looking at their ability to ramp these factories at an unprecedented pace that they have in China and really begin to take more substantial market share than the low single digit, or even less than single digit share in the light-duty vehicle space.
Meantime, another electric vehicle company, Nikola, which makes an electric truck, has been getting a lot of buzz. We then saw some Tesla news come out about their semi-ambitions. Is Nikola a threat to Tesla's truck vision?
So, we try not to comment on companies that we don't have under coverage, and we don't cover Nikola. What I will say is that the heavy-duty space is certainly ripe for technology change. We're seeing a lot of companies go after that space in terms of diversifying fuel base. And the race is on at this point. We're seeing test vehicles on the road. Tesla does have, compelling products from the EV side, but there's a lot of different fuel types, notably hydrogen, and natural gas that are also in the mix for cleaner fuel types for heavy-duty trucking and multiple trucking for inline applications. So as investors understand that part of the market is going to get disrupted at some point, more than likely, I think they are bidding on stocks. But again, the broader market dynamics are very unusual right now, in our opinion, given what's going on with interest rates and asymmetry of information.
All right. Colin Rush of Oppenheimer. Colin, thank you so much for weighing in. Coming up, is $25 billion enough to strengthen the U.S. chip industry? We'll talk about with the CEO of Global Foundries next. This is Bloomberg. U.S. lawmakers have proposed an estimated $25 billion in funding and tax credits to support domestic chip production in the United States and counter rising competition from China. Joining me now is the CEO of Global Foundries, Thomas Caulfield, a company that makes chips in the United States. Tom, thank you so much for joining us. First of all, is $25 billion enough?
First, thank you, Emily, for having me on. I think it's a good start. I think the U.S. has done a great job in sponsoring R&D, many mechanisms to go do that, to create the high-tech industry, and now starting with a solid $25 billion investment to accelerate manufacturing back into the U.S. is a great beginning for us. It's a great day for the semiconductor industry.
So, could this provide your company with a path to becoming a leading-edge manufacturer?
We're there already. The key here is to do more of it. If you look at the worldwide semiconductor manufacturing, only 12% of the capacity is in the U.S., and that's been a dwindling number over time. And it's important for supply chain mitigation to get a better proportionate amount of manufacturing back in the U.S., that investments like this are made that put the U.S. on a competitive level playing field with other countries that have made this a national priority for them for both security reasons and for economic reasons.
Meantime, you have Taiwan Semiconductor announcing that it plans to build a plant in the United States. What does that mean for Global Foundries?
Well, the semiconductor industry is pretty wide-ranging. What TSMC is proposing to build 3-4 years out is addresses a segment of the market that maybe is 25% of the need. The market has a broad range of technology needs, and Global Foundries participates in 75% of that market. The difference, I think, is we're already on the ground in the U.S. We have three major manufacturing facilities. In fact, we've invested over $13 billion over the last 10 years to create that manufacturing footprint. And the projects that we would be applying for would accelerate this and turbocharge expanding the manufacturing footprint in the U.S. And in fact, we have shovel-ready facilities ready to go, and we could begin getting the economic benefit of expanding our capacity, building on the footprint that's already here. The TSMC fab you're talking about is something that's going to be built in the future, and probably will not have job creation for a number of years out. Today we have over 7,000 employees in our North American operations. These are high-paying manufacturing technology jobs, and we can expand on that and accelerate the top-line growth of our business in partnership with these types of government investments.
Do you see the possibility of an alliance among U.S. chip makers? Would something like that make sense?
This is an industry that has, constantly found ways to partner because of the tremendous costs in R&D and manufacturing, and partnerships have been a way of life. Mergers and acquisitions have been a way of life because scale is so important. I wouldn't rule that out. They're just not naturally forming at this point in time. The industry's down to just 5 foundry players worldwide. Global Foundries is number 2. TSMC, the company you mentioned before, is number 1, and then there's Samsung, UMC, and SMIC. In fact, 3 of those last remaining foundries are Greater China-based, and we're the one really U.S.-based company.
So, last quick question. What are your biggest concerns about the China threat?
I think it's not about the China threat to the semiconductor industry. I think it's about us maintaining our leadership. It's important that for us all to be successful semiconductor companies, we have to participate in a global economy. We need open markets to go do that. I think we win this game by continuing to invest in R&D and continue to have co-investments with government agencies so that we could play on a competitive and fair level playing field. And the way to win this game is to stay ahead. You stay ahead by making sure that the industry continues to invest, governments invest at competitive levels, and we'll win the game by staying ahead.
All right. Thomas Caulfield, CEO of Global Foundries. Tom, thank you so much for joining us. Coming up, as many as 25,000 retail stores could close in the wake of the COVID-19 pandemic. What does that mean for online retail? We'll speak with Stitch Fix founder and CEO Katrina Lake next. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. Stitch Fix reporting quarterly results earlier this week, seeing a small sales decline, about 9%, as the pandemic disrupted the supply chain and backlogged orders. But as the trend to e-commerce accelerates, there's a lot of hope for online retail disruptors like Stitch Fix. Joining us now, founder and CEO of Stitch Fix, Katrina Lake. Kat, so good to have you back here on the show. Now, clothing sales dropped 80% across the board in the pandemic, but Stitch Fix sales fell 9%. Talk to us about what was driving that and what it shows about how the pandemic is impacting your business.
Yeah, I mean, this has been an incredibly challenging time, for many businesses. And, for us, actually, the primary challenge was really around the warehouse element of our supply chain. We have 6 distribution centers here in the U.S. and figuring out how to reopen, how to close, how to get those warehouses to full capacity has been a real challenge. We really felt like the employee right thing to do during these times was to give people the flexibility. So we gave everybody in our warehouses 4 weeks of paid time off to use flexibly, which was absolutely the right thing to do. But as a result of that, we had less capacity than we normally would. And so, against a backdrop that was showing 80% decline, of course, we're happy to have had just a 9% decline. But I think what's been most exciting is actually what we've been seeing in the weeks in the end of our last quarter and in the week coming out of this new quarter is that we've seen a lot of really positive growth and really great momentum. And what we've been seeing, not just our existing business, our fixed business, our clients who are getting those on a recurring basis be incredibly strong through this. The resilience of that, I think, really speaks to the product market fit of our business right now. I think the idea of having personalized stylist picks delivered to your home to try on in the comfort of your own home, I think that value proposition has never been more resonant than right now. And so we've been really thrilled to see that be successful. And then on top of that, what we shared in our earnings call was that direct buy, which is our latest innovation, which allows people to actually shop their recommended picks straight from us and have those shipped separately outside of a fix. The success of that throughout this, even with all of the uncertainty, that's been really exciting for us because that's a big area of investment for us in the future. And I think that's a really great lightweight way for people to engage with us, even in times of uncertainty.
Now, let's talk about demand as we come out of this. My kids don't seem to mind if I wear the same thing 5 days in a row, and many of us are still going to be working from home and social distancing for, potentially the next few months. What does that mean for demand as we come out of this, but slowly, for Stitch Fix?
Yeah, I mean, you're absolutely right. I think there is no question that people are going to buy less clothes this year than they did last year. There are going to be fewer events. People are not going to be going on vacations. There's unquestionably this market is going to shrink this year. That to us creates this big opportunity. When the market was down 80%, we were only down 9%. What that means is that we were capturing share during that time period. What we're going to see is pre-COVID, 80% of apparel was bought in stores. I mean, that's kind of amazing in this day and age that stores had such a big piece of that pie. And I think people are going to be really hesitant to go back into stores. I think people, well, like me, are really excited to get a haircut. But I don't know that many people are really excited to go back into a department store and try 20 things on in a fitting room. And for us, that's a real opportunity. And so we see tens of billions of dollars that used to be offline to be coming online. And a model like ours that really helps people to find jeans that fit, to find dresses that are right for their style, to really unlock those hard parts of the things that are hardest to do online with apparel. And that's exactly what we're good at. And so we're really excited about our positioning in this time. And so, the next 12 or 24 months, I think will be a very difficult time for apparel, and people will be buying less clothes. But we see this as an opportunity where we can really gain share and take advantage of a time when people are really excited to try a model like ours.
Now, you mentioned earlier it's been a hard time for the industry. You did lay off 18% of the company, 1,400 people, and I know that this has been heartbreaking for leaders of companies, for the people that this affects. How are you leading through this, and do you expect any more layoffs as we are now officially in a recession, and there are a lot of people out there who don't have disposable income right now?
No, this was, an incredibly, incredibly difficult decision. And it's really hard for all the stylists who are impacted. It's really hard for our team in general. The 1,400 part-time stylists in California was a very committed and talented group of people, and we couldn't have built the business without them. But really, our intention is to relocate as many of those stylists as we can. For a few hundred of those stylists, that decision was immediate, but actually the majority of those stylists are with us until September. And what that gives people a chance to do is to give a chance to think about something like relocation, or gives a chance to think about what's next for them, and to be able to give people as much time as possible, knowing that this is a challenging time, was an important part of what we did here. The reality, though, in terms of the reason we had to make this decision, was really around the cost of operating in California, and the complexity of operating in California is really challenging. And we have many, many talented stylists that are outside of California, and we know that there's an opportunity to create the 1,400 jobs and then some. We are actually planning to hire 2,000 stylists outside of the region. And so, it was a really, really difficult decision to make. But at the end of the day, this was the decision that we had to make, I think, as we think about how to create the opportunity to invest against the future, and in the long term to really create a company that can have as much of an impact and create as much jobs as we can in the long term.
Now, we're also in the middle of a social crisis, and you and I have talked a lot about diversity. I know it's really important to you. We've really focused on gender diversity, but, we're looking at a very huge racial divide in this country, and some very deep wounds that need to heal. What are you doing at the company to address this? And what do you think needs to change?
We could spend a long time talking about this. I think the incredibly distressing, horrifying events that have come to light in the last few weeks have been top of mind for all of us at the company. And I'm deeply concerned. I think we have a very long and hard road ahead, and we have a lot to do to create the equal and just society that we all purport to be, that we all want to be. I think at Stitch Fix, I found some solace and hope in the fact that we have strong values to rely on, and actually that our team and our employees are really coming together to stand up for what's right. And I think what was important to me in this moment is that it isn't just about this moment, and this is really about a time to create change. And so, I think I really felt like we could do more than contributions, which of course are important, but contributions and strong words, which are important, but trying to figure out what are the ways that we can really have a big, meaningful impact. And so, what we've committed to do is that we've committed $500,000 over the next 5 years to social justice organizations. We wanted to think about our own supply chain and how can we actually, with our economic power, create more equality. And the reality is that we realized we weren't working with enough vendors of color, and certainly not with enough Black vendors. And so trying to figure out how we can actually help that pipeline and support diverse entrepreneurs in fashion and apparel is another pillar of what we're focused on. And then the last bucket, which is an area, frankly, that we've always been focused on, is just how can we actually use our data to create change? And so you and I have talked a lot about gender equality, and that's certainly been an area of focus for us. We have a very diverse board and management team, especially across gender dynamics. But we definitely have some work to do when we think about representation in other dimensions. But what we're committing to do is actually share that data, to both share the data around representation, where we are strong, where we know we can do better, and then also around pay equity. And we haven't seen a lot of other companies sharing pay equity data. And at the end of the day, that's really important. Are you paying people the same amount for the same jobs, regardless of their skin color or their gender? And so these are things that I believe are really important. I think data can really create change. And I think this is a really hard moment for us in the country, but I'm getting more and more hope that it also can be a moment that we can look back and realize that it catalyzed real change.
Speaking of boards, you are also on the board of Grubhub, and we just learned that Just Eat Takeaway plans to buy Grubhub in an all-stock deal. They had been talking to Uber. I know you're a board member, but can you share your take on this outcome?
I obviously can't comment on that specific situation. I'm on the board of Grubhub. I'm on the board of Glossier. It's definitely been an exciting time for a lot of companies, and especially exciting time, I think, for digital-first companies like ours.
That said, as we've been talking about diversity, there's been a trend in some critical stories of women founders, CEOs, especially in the tech community, whether it's The Wing or Away. I was just looking back at some of those stories. One of the headlines was, "Are these female founder takedowns fair?" What is your take on this as, one of the most prominent female founders in Silicon Valley?
I'm not close to any of the details of any of those stories, but look, I deeply believe that representation is important. It's important for women. It's important for Black leaders. It's incredibly, incredibly important. And so, without knowing any context, I think for me, it's distressing to see that there's a lot of challenge in women in those positions. But the flip side is that I do think all of us business leaders, we should be held accountable. And I think this is a time when people are asking more business leaders, are asking us to stand up and talk about our values. And I think that needs to be equally held accountable across the whole business community. Female founders, female CEOs, we're a very small percentage, unfortunately, of the broader business community. And so, I think what is happening right now is that many, many people are being held more accountable. I think there are a lot of good things about that, but I would challenge us to make sure that we're holding everybody equally accountable, because this is the time that we all need to step up and we all need to do better.
Absolutely. All right, Stitch Fix founder and CEO Katrina Lake. So good to see you again. Katrina, thank you so much for joining us.
Thank you for having me.
All right, coming up, our exclusive interview with House Speaker Nancy Pelosi talking about police reform. That's next. This is Bloomberg. As people across U.S. cities continue to protest police brutality against the African-American community, Democrats on Capitol Hill have introduced sweeping reform that could make it easier to prosecute and sue law enforcement officers. House Speaker Nancy Pelosi spoke earlier with my colleague David Weston. Take a listen to that conversation.
It's so much stronger if we can work in a bipartisan way. So far, what we've seen from the Senate is weak, but nonetheless a recognition that there has to be some change. But I'll leave that up to the Karen Bass, our distinguished chair of the Congressional Black Caucus, as well as the chair of the Crime Subcommittee of the Judiciary Committee, working with Jerry Nadler, the chair of the full Judiciary Committee. I'll leave it up to them to have their interactions with the Republicans in the House as well as in the Senate, and hopefully with the White House. We do have an issue that relates to a qualified immunity doctrine that protects some police officers found to be engaged in misconduct from any, shall we say, exposure from families that are affected or lawsuits. So that is one area that has perhaps an area where we'll have some differences, but hopefully on the others we will not, and that we'll be able to find common ground. American people deserve that. American people expect it. American people are watching. We want to show them we've heard you, we see you, we've listened, we've learned how important this is to you, and we're going to do something about it. That's the question I was asked by George Floyd's brother yesterday when he came to testify before the Judiciary Committee in the Capitol. He said, I have one question for you. Will this become law? What makes you think so? What is different now? Well, different is the complete public awareness of the injustice of it all and the complete public outcry for change.
Any of us who've seen the video, not just of George Floyd, but also of other instances of police misconduct, know that there are some police we really have to correct. We have to get rid of them. We have to amend their behavior. At the same time, I'm sure you'd agree, the vast majority of police officers are doing a hard job and doing to the best of their ability. How difficult is it, on the one hand, to really police the police, but on the other hand, not be seen as really undermining them and being anti-police?
Well, I think that most of the police officers who are conducting themselves in a way that could be viewed publicly as responsible do not want to be painted with a brush of some bad apples that might be there in the mix. And so, again, policing the police is a responsibility that they have. But I also think that we have to recognize there's some racism that has to be addressed in our society as well as within our law enforcement community. And when we can rid ourselves of that, we'll go a long way to having justice in our policing.
Are the police unions a help or a hindrance in the reform of policing?
I've had a conversation with the president of one of the police unions, and they put out a very positive statement about our legislation. We didn't know what they might say, but it was very, shall we say, open to what we were proposing, ready to have the discussions. And again, as you say, overwhelmingly, police officers are there to protect us. I think they see their role as guardians, not warriors. And we just have to hope for the best in that regard and invite them to the table so they can be part of the discussion. Some places it's different. Some places, some of the union officials have been very, shall we say, more protected than they need to be of bad conduct. But we have to make those distinctions.
House Speaker Nancy Pelosi there with David Weston. We'll have more of Bloomberg Technology after this quick break. This is Bloomberg. The travel industry has come to a standstill as a result of the pandemic. So what does that mean for airlines? Earlier today, we spoke with President and COO of JetBlue, Joanna Garrity. Take a listen to what she had to say.
What we've learned is the only thing certain is that there is a lot of uncertainty. So as you see things folding in the news media today, regarding increasing cases in certain parts of the United States, our focus has really been on how do we build customer confidence in flying again. We've seen small glimmers of hope in the leisure sector. JetBlue is largely a domestic carrier, and we think that domestic travel will come back sooner than international travel, and leisure obviously coming back sooner than business travel.
Just in terms of how the business is ultimately going to evolve, though, there are some key dates coming up. And one of those comes at the end of September when the CARES Act money and the restrictions that it brings start to expire. You will then have the freedom to start to change this airline to fit the new reality. What is JetBlue going to look like in that environment?
Correct. So first, I'll just say, we've been very lucky to be a recipient of CARES Act payroll dollars. It covers about 76% of our payroll. After September 30th, when the CARES Act payroll dollars cease, we're looking at what the size and shape of JetBlue will look like. We're obviously going to be a smaller airline, but again, it's so difficult to predict that far out. Every week we learn so much more about the impact of the coronavirus. We're really looking to June and July as signals as to demand recovery and what we think the coming months are going to look like.
In terms of what that demand is looking like right now, you say that at the moment, as you kind of are positioned in the leisure market, that's where the primary kind of area is. Is it people going to see sort of friends and family that you're seeing demand from at the moment, or is it genuine kind of leisure travel?
So it's a combination of two things. So we are seeing a pent-up demand for leisure travel, but we're also seeing customers going back and seeing their family and friends. And we've seen this in prior events, whether there's political unrest or whether there are hurricanes and whatnot, that, the VFR customer segment of people really going to visit their friends and relatives, it tends to come back earlier than, for example, the business sector.
Just in terms of the concerns that passengers have, what are you seeing at the moment? What feedback are you getting from the passengers that you are taking on board at the moment? You referenced safety a little bit earlier on. What feedback are you getting?
Sure. We're measuring very closely every week what is important for customers to rebuild their confidence in traveling again. Obviously, some of the top items are cleanliness of the aircraft, social distancing and physical distancing is also very high on the list. We've built a program that will continue to evolve around those very things our customers are telling us will make it confident for them to travel again. They want our crew members to be healthy when we're serving them, a focus on air and clean surfaces, reduced service touch points, so we're no longer providing some of our higher touch service. And then obviously travel flexibility is also an important component.
What are your staff telling you, Joanna?
Our staff are very focused on the success of JetBlue. Everybody is focused on trying to ensure that we're doing everything we can so that customers start feeling comfortable flying again, whether that's how we serve them, whether that's the cleaning products and policies and procedures we have in place. Our crew members are very dedicated to JetBlue. We have a unique culture here. It's very much a family, and everybody is rowing in the same direction, trying to make sure that JetBlue weathers this storm and emerges as strong as it was when it entered.
How do you think the network is going to change as a result of COVID-19? I want to come on and talk about London. You have the banner behind you in just a moment. But within the United States, you are largely, as you say, a domestically focused carrier. How does the network change? How does the offering change? Do you think things like your front of the plane Mint offering changes? How are you going to reconfigure?
I'll speak to network first. So as you mentioned, we're largely a domestic carrier. 70% of the seats we fly are in the domestic markets, and then 80% of the customers that we carry are leisure. So we feel that we're set up for a recovery sooner than some other airlines. We do think that domestic will return quicker. We think that short haul international will return quicker than longer haul international. Right now, international is sort of a patchwork of different openings, and so we're watching that very closely. But I think from JetBlue's perspective, as customers start getting confident traveling again, we do think that we're well positioned to take advantage of that.
Joanne Garrity there, President and COO of JetBlue. And that does it for this edition of Bloomberg Technology. Bloomberg Daybreak Australia is next. I'm Emily Chang. This is Bloomberg.